What's up, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex, and today we're going to be going over Robinhood stock, ticker symbol HOOD. And right now it has a ton of momentum. As we can see, it's up 50% on the day, sitting at a price point of $66. And it did hit highs early morning of around of around $85. Hit exactly $85 per share, with a 52-week low of $33. So a lot of people, especially ARK Invest, Kathy Woods, she was buying this stock at around $33 per share because she saw it as a really good buy. And long term, this company, this brokerage, makes a ton of cash and has a lot of good revenue growth. And just overall, a lot of retail investors love this platform. So right now we're seeing a lot of volatility. We have this nice gap up in the pre-market. Very, very big movement, lots of volume. As we can see, there's a gap that we do need to fill around this $54, $46, $47 price range. So if we see some pullbacks with Hood stock, it could fill up that gap because there is no support here yet. So that's what's happening with this stock. Very, very volatile, and options have came out for this ticker symbol. Take a look at the average volume, 25 million. Today was 175 million shares being traded. So very, very volatile, and it's basically a meme stock at this point. As you can see, a lot of articles coming out. Robinhood catching its own meme stock spotlight with a wild 100% surge. And a lot of people, especially everyone who got into this stock during IPO at around $38, they're making a ton of money. They basically doubled their investment. So a lot of people are pretty happy about that. But as fast as a stock can rise, of course, it can fall just as quick. So make sure to take profits when you see it. It probably can continue this run up for a while, but eventually it will need some sort of pullback because this sort of price action is not sustainable in the long run. So my anticipation is eventually, if it has to pull back, we will have to pull back at this around $54, $46 price range. It needs to fill that gap and fill it up with some support levels. But overall, if you want to play options, there's a very good opportunity for the options market, not only because the options chain is fresh, but because a lot of people are looking to make money off of this stock via options. So right now, since options are new, that means supply is very, very limited. Not many people are selling options for the options buyers. So that means there's a huge demand for it, but very little supply. And what does that mean? That means higher premiums on your contracts. As we can see here, a $70 call option expiring in 2 to 3 weeks. It's going to cost you almost $1,400. It's very expensive. Implied volatility is over 200%. Very, very volatile. Theta decay is going to be killer. You're going to lose $41 on your premium every single day due to time decay. So that is something to keep in mind. And if you want to play options on this stock, do not buy options. There's very limited supply, huge demand, and overall, it's going to be pretty risky if you want to play options for the options buyers. On the other hand, if you're an options seller, this is a very good opportunity. Very, very high demand for the options, but not much supply. So if you can supply some of these options by selling, whether it be covered calls or cash secured puts, you can capitalize on these higher premiums and you can make some decent profit. So for example, if you're holding 100 shares, you can sell a covered call, and a covered call expiring August 20th. We could see sell and call. I don't own 100 shares, but if you sell a call, you can collect a credit of $1,400, which is pretty sweet. So as long as the Hood stock stays below $70, you're going to collect your $1,400 in full. And of course, if it goes above $70, you're going to have to sell your 100 shares at $70 each, which is $4. movement. So you're going to be making money not only on your capital appreciation, but you're also going to be making money on the premium that you're collecting. A very, very big premium. And unfortunately, the highest strike right now is going to be the $70 one. So a lot of people are going to be looking to buy that one. Until they come out with some updated options contracts. But if you don't own any shares of this stock, you could sell some cash secured puts. It's going to cost you a few $1,000s. Because remember, you need to put down collateral equal to the strike price times 100. So you're going to need around $5,000 to $6,000 of buying power in order to open up a cash secured put. So for example, you could sell a cash secured put at the $60 price point and you will collect $880 of premium. Your chance of profit is going to be around 63%, so you're most likely going to win on this contract. And implied volatility is pretty high. That means the premiums are going to be inflated, and once the volatility dies down, as we can see, after this huge gap up, volatility is slowly dying down. It's slowly stabilizing. And then once implied volatility drops, you can make money that way, because once the implied volatility drops, then the premiums are going to drop as well because they're not much in demand. Theta decay is pretty good on this contract. It's going to lose $40 every single day due to time decay, which is very good if you're selling options. It's bad if you're buying options, but if you're selling these contracts, you want the premiums to bleed out, and that's how you're going to be making most of your profit. And of course, if the premium bleeds out enough, say this goes to $50 a contract, you can buy it to close early. You don't have to wait until expiration, and that's normally what people like myself do as options sellers. Very, very good way to make profit early on these contracts. And it's basically selling options on high implied volatility stocks is one of the best ways and my favorite ways to sell options, whether it be cash secured puts or covered calls. I mostly sell cash secured puts to take advantage of the higher implied volatility, as well as a chance to buy stock at a lower price. Because remember, if Hood goes under $60 at expiration, keep in mind, you have to buy 100 shares at $60 each, but you do collect your $880 of premium, so that does lower your cost basis to $51.20 per share, which is $15 under the current stock price, and that is a very good price point to own shares. Very safe, and you're most likely going to win rather than lose, because buying options, buying calls, buying puts is very risky, and most options traders who are doing that end up losing money. So this is going to be the best way to play options on this stock. But overall, very, very volatile, so you have to be careful when trading this stock. It is due for a pullback. It's up 50% on the day. Stocks can't go up forever, and eventually people will decide, hey, this is a good price point, I want to take profits, and then we'll see some nice pullbacks. And as we can see in the technical analysis, we do have this gap to fill right here. So that's about it for this video. If it helped you in any way, please leave a like, comment down below what your thoughts are on Robinhood stock. Should you get into it? Are you going to play options? And of course, subscribe if you're new to the channel. It helps out a lot. Thanks for watching.